why would you say investors should go active and not just buy index funds?
Let me paint a picture for you of what's actually in the benchmark that we use for our small cap growth portfolios. What might surprise you is that over 40% of the companies in that index today are unprofitable. Sometimes you can have a front row seat to history in the making and you don't even realize it at the time. When I was covering Amazon back in the 1990s, it was essentially just an online bookstore.
Do you think it will be more favorable environment towards small stocks?
I do think it will be. What excites me most isn't just that these companies are using AI, it's how they're using it. What I find particularly interesting is how many traditionally feminine traits translate incredibly well to investing.
Hello and welcome to the Investing in Other Stories podcast. I'm Margarita Tri, your host and founder of Finance Latte and leading investing education company. The information on this podcast is for informational purposes only. It should not be considered investment advice. Stay tuned for more important disclosures at the end of this episode. Before we begin, a big thank you to our sponsor, FinChat.io, your go-to place for stock market analytics and AI-enabled investing tools. Our guest today is Rayna Lesser Hannaway. Rayna heads the small company growth team and is lead portfolio manager at Polen Capital's US Small and SMID Growth Strategies and is co-portfolio manager of the firm's global SMID strategy. Prior to joining Polen Capital in 2017, Rayna spent 9 years in portfolio management and 2 years as a research analyst at Fidelity, evaluating small and mid-sized companies. She has also spent 9 years working in small cap research for Janison Associates and Lord Abbett. Rayna received a bachelor's in economics from Barnard College, a division of Columbia University, where she graduated summa cum laude. Rayna is a CFA charter holder and launched Polen's WISE Employee Resource Group with a goal to support and promote an inclusive and supportive culture for women and their allies across the asset management industry. Rayna, what a resume. It's great to have you here with us and a warm welcome to our podcast.
Thank you so much, Margarita. I'm really excited to be here and to have this conversation with you today.
Same here. All right, let's start at the beginning. Did you always aspire to have a career in finance?
The quick answer is no. I knew I wanted to be in finance, but I wasn't sure about asset management. But when I was graduating college, there was almost this predetermined path that everyone was taking, going into either investment banking or pursuing roles in sales and trading. And those didn't seem like the right fit for me. I found myself wanting something different. I was looking for something that was less transactional, where I could really dig deep into companies and into relationships and watch them evolve and grow over time. I was very lucky after graduating college to be introduced to a portfolio manager at Lord Abbett and Company who managed their small cap growth team, Stephen Magruder. And I was offered a job as his assistant, but quickly transitioned into a research role covering technology companies. What really grabbed me from day one was the intellectual challenge. Every company I looked at was like a new puzzle to solve, and each day brought fresh opportunities to learn. Looking back, that's really what's kept me in this business for as long as I've been doing this. It never gets stale. Markets evolve, companies transform. There's always something new to understand and to analyze, and that constant learning curve has kept me engaged and really excited about what I do.
It's a continuous learning curve, and it's not just you learn it once and you just practice it afterward. You always have to stay on top of the market. That can be exciting for a lot of people. So I wanted to ask you about another misconception I keep hearing, particularly among individual investors outside the industry. And that's the belief that index funds are just a good solution for every asset class. I was looking at the statistics for the small cap growth space, which is where you invest in, and I saw that more than 2/3 of active funds actually outperformed the small growth index over 10 years, according to Morningstar. So these numbers essentially disprove that assumption. From your perspective, why would you say investors should go active and not just buy index funds?
Let me paint a picture for you of what's actually in the Russell 2000 growth, which is the benchmark that we use for our small cap growth portfolios. What might surprise you is that over 40% of the companies in that index today are unprofitable. And then there are many others that are laden with debt. Does this mean that all of those companies are bad investments? No, there certainly are periods where more speculative companies can perform well in the small cap universe. But as an active manager, I have the ability to be very selective and keep the quality bar very high and focused on companies that have the conditions in place and the behaviors in place to drive long-term compounding. And that's how you win over the long term. Think of it this way. Relative to large caps, most companies that are large, they already have proven business models. They've survived and they've thrived to reach that size. But in small caps, you're often dealing with unproven business models, earlier stage companies, and that's exactly what you get for a large portion of the index. It's also why the deep research and the careful selection become more crucial. It's not just about picking the winners when you're investing in small caps. To win, you need to avoid the landmines, and there are a lot of them. So that's why I believe that active management in small caps is not just an option, it's actually a risk management tool. You want someone doing the fundamental work, looking under the hood, and making those very intentional decisions about where to invest.
That makes total sense. It's a lot of speculative and lower quality names in the universe that by default the index funds buy all at once in one basket. So thank you for sharing that insight. So your investment strategy is quality growth, and the word quality, at least from my perspective, as somebody who has been hearing that in the business for so long, has been so overused to the point it has just lost a lot of its meaning. So can you please describe how you define quality companies?
Sure. When we talk about quality, what we're looking for are companies that have already cleared some crucial hurdles. We're not betting on promises or companies that just have a great strategic vision. We're looking for companies that are really operating at the intersection of that great vision with execution skills and capital allocation know-how to make that vision a reality. And the way I like to think about this is we're not betting on promises. We're looking for proof in the management team, proof in the margins, proof in the returns on invested capital. These companies are already generating real cash flow, not just showing revenue growth. They have margin structures that allow them to convert a meaningful portion of their revenue into cash. And crucially, they're demonstrating that they have very high returns on capital, which often means that they have a lot of excess cash flow that they can then use to reinvest in their business and support their long-term growth plans. Think of it like this. These companies, they're not trying to figure out whether their business models work. They already know that their business models work, and they can make very intentional decisions around how to drive the best outcomes in the future.
Thank you. That's really helpful. And it really sets the stage as to understanding how you invest as well. I want to talk about mindset for a second. You talked a little bit about the universe already, but what type of mindset do you need when you're building a concentrated portfolio of those small growth companies?
What I would say is that being a small cap investor requires a pretty unique combination of traits. I found that the mental aspects of the job are just as important as the technical skills, if not more. First, you need to be insatiably curious. You're constantly asking why and what if, because in small caps, you're often dealing with companies that are still writing their stories. You need to be genuinely excited about digging into new business models, understanding emerging trends, and connecting the dots that others might miss. That curiosity, it has to be balanced with humility. Markets have a way of teaching us lessons pretty quickly in small caps. You can do all the right analysis, but new information can change the picture overnight. And that's why cognitive flexibility is absolutely crucial. You need to be willing to change your mind when the facts change. And you can't let your ego get in the way of making the right decision for your portfolio. Let's be honest, the emotional aspect. Small caps can be volatile, really volatile. This year is definitely a testament to that. You need to be able to maintain your analytical clarity even when a stock drops 20% in a day, or when the whole sector that you're investing in goes through a rough patch. That can be really hard. It can especially be hard for many who, when they were students, they excelled at everything that they did. As an investor, you're often wrong nearly as much as you're right. And that can be pretty painful. You have to be able to think clearly and rationally during those volatile periods.
That's a great insight into the type of mindset you need. My next question is about something I saw you wrote on LinkedIn, and I really enjoyed reading that, where you've talked about how you've been investing in this space for so long that you have seen enormous companies evolve, but you saw them way back then. Like you saw Amazon back when it only sold books, Netflix when it only mailed DVDs. That is such an incredible advantage to have that experience and seeing which companies make it all the way to market leader. If you think of yourself as an analyst back then, what characteristics would you say stood out for those companies back then?
What's really fascinating about this business is sometimes you can have a front row seat to history in the making and you don't even realize it at the time. When I was covering Amazon back in the 1990s, it was essentially just an online bookstore. And if you told me that this company would eventually be one of the most valuable companies in the world and one of the most meaningful in our everyday lives, I probably wouldn't have believed you. But what I found over time and what I saw back then are a certain set of behaviors that I believe really sets apart the companies that are going to become the next leaders versus the ones that are stuck in small cap forever. And a lot of it comes down to consistently reinvesting in the future and having an abundance of opportunity to reinvest in the future at high rates of return so that a company can extend its compounding period, expand its TAM, create more durable competitive advantages over time. When I first covered Amazon, I couldn't have mapped out exactly how they'd become what they are today. What I could identify were those reinvestment behaviors and that they were doing it in smart places and with a lot of discipline. Those are the kinds of opportunities and behaviors that we look for in all of our companies today.
That is absolutely fascinating. And I love how you said that you're witnessing history and you might not realize it, but in retrospect, I think the lessons learned are just enormous. And I really appreciate the perspective. And my next question is about Fama French, a well-known academic study that has shown that historically over long periods of time, small companies perform better and justify their risk. And small is defined in this case as market capitalization. Yet in the last few years, with the large tech stocks dominating the markets and the big firms keep getting bigger and bigger, the market seems to only be excited for that space. But moving forward, do you think it will be a more favorable environment towards small stocks?
I do think it will be. And what we're seeing right now in small caps is actually pretty consistent with a classic pattern that you can see when you look at market history. Large caps and small caps, they tend to trade off leadership. And sometimes those cycles can last for a surprisingly long time, as much as 15 to 16 years. So to me, when I look at this, I think it's all part of a normal pattern. Now, what gets me excited about small caps looking forward is that these transitions often coincide with significant shifts in financial conditions, like declining interest rates, which is exactly where we find ourselves today. The other things that stand out to me are that small caps have been in a tough position over the past few years relative to large caps, in that they had a harder time dealing with the transition from the pandemic pandemic to the post-pandemic period, while at the same time experiencing high inflation and high interest rates. That was really hard for them. It created a real headwind for many small cap companies in terms of their growth and their profitability. And so large cap delivered better fundamental outcomes than small cap over the last few years. But looking forward, I think that next year will be the first year where we see small cap deliver better earnings and cash flow growth than large caps. And I believe that is exactly what needs to happen to put small caps in a leadership position. The other things that stand out to me are that small caps from a valuation perspective look very attractive, whether you're looking at it on an absolute valuation or relative to large cap. The gap is about as wide as it's ever been. And so that too is often a good condition for shifting leadership. The last thing that I would point to, and I remember this vividly from earlier in my career, is that if people are asking today, do I ever need to own small caps again? I can get whatever I need in terms of return from large companies. I remember in 2000 when the market was also very concentrated in large caps, people asking that very question. But the question that they should have been asking is now the time to own small cap. We have to be careful not to look in the rear view mirror here and instead look at the windshield and what's in front of us and understand what the conditions are for that leadership.
That makes perfect sense to me as someone who has seen these cycles and styles and market caps go in and out of favor. My next question ties to what we're saying now, and it's about the AI and all the tech spend that has happened. We've seen large stocks just spend billions of dollars to invest what they need to invest in innovation and AI related expenditures. How are small cap companies competing against the big ones in the race to embrace AI and build that infrastructure that they need to compete?
I spent many years of my career focused on technology companies. And what really interesting that I've observed over the many paradigm shifts that I've experienced in technology during my career is that often it is the large companies that are making the initial heavy investments in new technologies, but they actually lay the groundwork for small companies. Think about cloud computing. Companies like Amazon and Microsoft made the massive upfront investments, but then democratized access to that technology for companies of all sizes, and not just the small companies that we look at that are public companies, but also those that are much smaller. I believe that in AI, we'll see a similar pattern. So while the large tech companies are building foundational models and infrastructure, they're also making these tools widely accessible. We're all using many of these tools already today, and this is just the beginning. I actually think that this gets really interesting for small caps when you think about how our small cap companies can utilize this technology. I believe they'll be able to use it in ways that can help to enhance their productivity and drive efficiencies. There are a few companies that we're focused on where I'm already seeing evidence of this. Take Paycom, for example. They're using AI to revolutionize how businesses handle payroll or HR functions. Or I look at a company like Revolve Group in the fashion space. They're leveraging AI to optimize their inventory and personalize customer experiences. Or CCC is another great example. They're integrating AI into their auto claims processing to dramatically improve efficiency. What excites me most isn't just that these companies are using AI, it's how they're using it. They're not trying to compete with the tech giants. They're not trying to develop their own foundational models. Instead, they're pragmatically applying AI to solve specific business problems and generate better outcomes for their customers and their shareholders. They're using it to enhance productivity. They're using it to streamline operations. They can reduce their costs. They can improve customer experiences. While the narrative narrative today is more focused on how large caps are investing in AI. I think the real story here is how all of the other companies are becoming early adopters and practical implementers of AI solutions. That's where the real value is going to be over the long term.
That's such a great way to think about it. And just a follow-up question on that. Do you think there's a particular industry that will benefit most from these productivity gains and other operational efficiencies, or it really is business to business dependent?
I think that the opportunity is there for companies across all sectors and industries. It just needs to be harnessed appropriately.
All right, so let's switch gears. Since I left New York, I've been speaking to a lot of people, particularly women who have never invested before. And I often hear this obstacle that keeps them from investing, and that's the fear of not knowing enough. I want to ask you, you're a professional investor, you've done this for a long time. Do individuals need to be experts to start investing? Do you have any advice on how to essentially learn to invest as you go?
I always smile when I hear this kind of question because everyone, myself included, and of course you, Margarita, started from exactly the place of not knowing. What's fascinating about women and investing is that the research consistently shows that women actually tend to be excellent investors. They often take a more measured approach. They're better when it comes to risk management. They're less prone to overconfidence. They do more thorough research. All of these qualities lead to better long-term results. What I find particularly interesting is how many traditionally feminine traits translate incredibly well to investing. Things like strong emotional intelligence help in understanding management teams. Things like being able to multitask are perfect for juggling multiple company analyses at the same time. Or attention to detail, which is often something that women are successful with, is crucial for company due diligence. The ability to take a long-term view, that's exactly what great investing requires. Let me be practical for a moment. The resources available today for someone who is interested in pursuing this journey are far better than when I began my career nearly 29 years ago. There are amazing online courses. There's investment communities. There's professional organizations focusing on women in finance. There are so many books that break down complex topics into digestible pieces and podcasts that you can listen to on a weekly basis that help you up your investing game. The barriers to entry have never been lower and the support system has never been stronger. What I tell women who are interested in investing is don't feel like you need to know everything before you start. Begin with what interests you. Maybe you're a consumer, you love to shop and you understand retail trends. Look into consumer companies, or you work in healthcare and see emerging patterns. That might be a great place for you to take a look and try to understand how those companies work. The knowledge that you bring to the investing table, no matter what it is incredibly valuable, and it can actually be a competitive advantage. So start there and build outward. The beauty of this field is that you never stop learning. Even after nearly 29 years in this business, I'm constantly discovering new things and learning new lessons. That's not a weakness. It's what makes this career intellectually rewarding. So if you're interested in investing, take that first step. The only prerequisite is curiosity and a willingness to learn and humility and self-awareness.
Wow, what a fantastic response. I hope everybody who's listening is motivated to get started after this. All right, and talking about women and investing, you are one of the only 2% of mutual funds in the US that are led by female-only portfolio managers compared to the nearly 85% of those that are male-only PMs. And I want to bring up your work on women inspiring success and engagement, or also called WISE, at Polen Capital, that you co-founded, that helps tackle this issue. Can you tell us a little bit more about that initiative? If you look at all these efforts and specific activities that you've done within that group, what would you say has been most effective in terms of bringing change?
being part of the minority of female portfolio managers in the US is both a stark reminder of how far we still need to go. And honestly, it's a source of motivation for me. Throughout my career, I didn't have many female mentors, not because women aren't capable investors, but simply because there weren't very many women in those roles. As I reflect on my career, what I think is needed in order to change the game for women is to really show up for women and provide that support and mentorship, be that role model. And so when I was given the opportunity to co-chair our women's focused ERG, Women Inspiring Success and Engagement, we call it WISE, I didn't hesitate for a second. It was a chance to create the kind of support system at Polen Capital that I wish I had early in my career. What's been truly amazing is that it's created this incredible network inside the firm that connects women across every part of our organization, from investing to operations to technology, marketing, client service. What's really fascinating when you create those connections is you don't just support women, you actually can transform the entire organization because you're creating all of these points for collaboration across functional teams. And so I believe that this kind of work, bringing people together to get to know each other in these ways where they feel very comfortable and there's a lot of psychological safety in how they connect, really can help to transform organizations while also providing a great platform for women to succeed in this business. And honestly, you asked about initiatives. I don't think it's any specific program or initiative. It's really the organic ecosystem that something like this creates. It's about making one woman comfortable reaching out to someone else in the organization. It's about a woman sharing insights with other women inside of the organization. These kinds of connections are just creating these amazing webs of women and functional collaboration throughout our organization that can make each of us more effective, each of us more confident, and can make our organization more effective. What I really love is that these kinds of relationships, they cascade outward. When women in different roles are supporting each other, they become better equipped to support folks outside of Polen Capital, to attract women to our firm, to encourage women to become investors or to work in asset management in other crucial roles. It has this wonderful multiplier effect that extends beyond our organization, and I hope really sets the foundation for change over the long term.
I could not agree more. And I can see how having role models, mentorship, visibility, and psychological safety cannot be underestimated. And talking about careers in finance, what advice would you give to younger women or any woman who is considering a career in finance?
You know what? I would say just go for it. I say that with conviction because after nearly 29 years in this business, I still wake up excited every day about what I do. And that's pretty rare in any career. What makes finance and particularly investment management such an amazing field for women is that it constantly engages your intellectual curiosity and your analytical skills. You're always learning about new businesses, trends, evolving technologies. No 2 days are the same. And just when you think you've figured something out, the market throws you a new challenge to tackle. What I wish someone had told me earlier in my career is that many of the traits that women naturally possess, that attention to detail, emotional intelligence, long-term thinking, careful risk management, like I talked about before, they're actually incredible assets in this field. And so as women, we're not fighting against our natural tendencies, we're leveraging them. My advice is don't let uncertainty hold you back. Don't wait till you feel like you know everything, because none of us ever do. And that's actually one of the best parts about this business and this career.
Wonderful. And is there a book book about investing that you recommend to those outside the industry or even those in it? What would be your top recommendation?
So, from my perspective, some of the most valuable books for investors aren't necessarily just about investing. I'll share a few that I think are particularly insightful, each for different reasons. The Outsiders by William Thorndike is a book I find myself coming back to repeatedly. Basically, what he does in this book is he profiles extraordinary CEOs who didn't necessarily fit the conventional mold, but delivered exceptional returns for their shareholders because they were excellent capital allocators. I think that this book is really fascinating because it helps to reframe what great leadership looks like, and it brings a lot of attention to an area, capital allocation, where it's hard to find skilled management teams. And so I believe that this book brings attention to something that we should be paying a lot of attention to and bringing a lot of intention to when we're evaluating management teams. This is a key thing to look for in leadership. Another book that I really love is Thinking in Bets by Annie Duke. It's actually written by a former professional poker player. What I love about it's about decision making under uncertainty, which is exactly what we do as investors. In investing, you could make a perfectly good decision and have a great process for making a decision and still get an unfavorable outcome due to factors outside of your control. I think that this book really helps to focus on improving decision-making processes rather than getting caught up in short-term results, which so many investors do. And it actually may be the wrong feedback loop if you want to become a better investor. The last book that I would name is Great by Choice by Jim Collins. And I actually love all of Jim Collins's books. I think that this one is particularly valuable because it examines why some companies thrive in uncertain, chaotic environments while others don't. And what his research shows is that it isn't really about being the most innovative or taking the biggest risks. It's about having a lot of discipline and a very consistent approach to growth. This is important not just for the companies that we're investing in. It's also important to us as investors and really resonates with me in how we think about evaluating companies and how we think about evaluating ourselves.
Wonderful. I have not read any of these books, although I've read Jim Collins' classic, The Good to Great. But thank you for sharing. I will definitely put them on my to-read list. So one more investing related question about your career. Can you share with us one of your top investment decisions? What led to that success?
So sometimes the most compelling investment opportunities come in pretty simple packages. For compliance reasons, I'm not going to mention the company by name, but the example that I'd like to cite here is a chicken wing restaurant chain that we invested in back in 2019. And it's not exactly what you would think of as an exciting growth story, but that's exactly where the opportunity lay. So what fascinated us about this company was that they had created an incredibly compelling economic model for their franchisees. When we looked under the hood, what we saw was that franchisees were generating returns that significantly outpace other franchise opportunities that they might have to invest in. And that's really crucial in a business like this because it creates a virtuous cycle where those strong unit economics help to attract better franchisees and more franchisees. When you have those better franchisees, then they execute better, which reinforces the brand's success. And so that's what really set this story apart. What also stood out to us is that management was consistently making really smart, forward-thinking decisions to enhance their opportunity and to make it larger. They didn't just rest on the business as it was then. They were constantly thinking about how to thoughtfully expand their menu. They added items like a chicken sandwich which sounds simple, but it actually changed the game for them in some ways. It helped them capture more lunchtime business. It also helped them capture more families. And that's a big deal. If you have a family where one child doesn't like chicken wings, you might not go there if that's all that the restaurant sells. And so that really helped them. The other thing that stood out is they were early adopters when it came to things like digital ordering and delivery, which positioned them incredibly well when the pandemic hit. What I love about this is that it just demonstrates several key principles that we look for. Start with a strong business model. In this case, it was superior franchise economics. Next, focus on management teams that are constantly thinking about how to make their opportunity better without straying from their core competency. And then third, and this is certainly the case with chicken and chicken wings, pay attention to businesses that appeal to a broad demographic. This company's appeal transcends age groups and income levels, which gives them a lot of opportunity and tremendous runway for growth in nearly any environment.
Fantastic. I would have not expected that from this type of company, but the fundamental drivers you mentioned all made perfect sense. So, Rayna, if you had to summarize 3 key tips for success when investing in small companies, what would those be?
So 3 key principles that I've found crucial for success in small cap investing, they might not be what you expect. First is what I call the execution, vision, capital allocation intersection. And I focused on this earlier in our conversation. And what I mean by that is don't look for companies that have just a compelling vision. They all have a compelling vision, but instead look for companies that possess operational excellence and capital allocation excellence so that they can make those dreams come true. And these kinds of companies, they're really hard to find. It's quite uncommon to find management teams that excel at both dreaming big and executing with discipline. But when you do find them, they're often the ones that create extraordinary long-term value. They're the ones that can take a small company and transform it into something much, much larger. Second, and this is crucial, you need patience, not just the kind of patience where you can wait out market volatility, but the kind where you give a great management team with a really compelling strategy time to compound. And sometimes it takes a while for that vision and strategy and execution and capital allocation to come together in a way where the market really recognizes that quality, especially for smaller companies that don't have well-known brands and are really flying under the radar screen of most investors. What I would say the focus should be is always on the fundamental progress of the business rather than getting caught up in short-term price movements. Great companies take a longer time to realize their potential than what you might expect. And oftentimes things can separate from their intrinsic value for quite some time. So you may get feedback from the market that is not favorable, but you need to hold your ground and also be open-minded to understand if something's changing. And then third, and this one might seem counterintuitive, is actively seek out opinions that challenge your own. It's easy to fall in love with an investment thesis, especially when you've done a lot of research. But the best investment decisions, they come from rigorously testing your assumptions and being open to different perspectives. So whether it's talking to the analyst next door or to competitors, customers, industry experts, or simply engaging with your friends, maybe customers of a company or employees at a company who may see things differently. All of these viewpoints can either strengthen your conviction or help you identify blind spots before they become problems. I've got to add just one more. I've got a fourth one to add that I think is essential. And it's that in investing, humility is vital. You need to recognize that no one has all the answers and markets are unpredictable, and always stay open-minded to learning. And part of being able to do that is admitting you don't know everything. That will help you make more informed, less ego-driven decisions. It's better to change course than to double down on incorrect assumptions, and to bring that self-awareness, bring that humility, recognize when there are other perspectives to take in. That's really going to help with the research and decision-making process. And then finally, where I'll leave you is that my most important motto in life, and this is not just as an investor, it's also as a mother, is that you want to wake up every day and focus on how you can get better. That also requires you to bring that self-awareness and humility and appreciate that you've got room to grow and really be able to harness those lessons in the right ways and focus on the things that can help you just get a little bit better every single day. Because none of us as investors, as mothers, or like in any of our roles, do everything perfectly all of the time. Investing is a really challenging career to pursue, but it's also one that's incredibly fulfilling and enables a lot of growth.
Rayna, thank you so much for joining us on the podcast and for the deep insights into small cap investing that you shared with our listeners. Such great insights. And thank you all for listening to the Investing in Other Stories podcast. If you enjoyed this content, please take a moment to subscribe to and rate the podcast on Apple, Spotify, or wherever you get your podcasts. You can follow me, Margarita Tri Affiliate, on LinkedIn, or at Finance Latte on Instagram. And you can learn more about Rayna Lesser Hannaway at Polen Capital's website. Cheers and see you next time. The information provided on this podcast is for informational purposes only and should not be considered investment advice. The opinions expressed on this podcast are as of the day of the recording and are subject to change without notice. The views and opinions of guests on this podcast are not necessarily those of Finance Latte AB or its host Margarita Tri Affiliate, collectively referred to as Finance Latte. Finance Latte is not affiliated with its guests or their affiliates unless otherwise stated. Finance Latte does not guarantee the accuracy or the completeness of the data presented herein. The information on this podcast is for informational purposes only, and the information, data, analysis, and opinions it includes should not be considered investment advice or tax advice, and is therefore not an offer to buy or sell a security. Finance Latte AB is not responsible for damages or other losses resulting from or related to the information, data, analysis, or opinions in the recording. Past performance does not guarantee future results. All investments are subject to investment risk, including loss of principal. Individuals should consider their own unique needs and circumstances and objectives before making investment decisions. Please consult with a tax or financial advisor for advice specific to your individual circumstances.